We had the worst week for the S&P 500 since March 2023, with pretty much every stock right across the board dropping. We see the likes of Nvidia down nearly 13%. We have Google, another big loser of the week, down around 6.9%. And when we take a look at the fear and greed index, currently now we have entered fear territory. And as we always mention on this channel, the market sentiment can change very, very quickly. In fact, last month we were sitting at extreme fear, a week ago in greed. In fact, the previous market close was neutral, and now, as we mentioned, the market is sitting on eggshells. Now, in today's episode, we are going to be taking a look at 8 undervalued dividend stocks that we believe are at some very good prices for your consideration. As always, we're going to look at each one's historical performance. We're going to talk a little bit about how their previous earnings have been, what is forecasted for their future, as well as movement to their forward P. And we're going to do an in-depth metric analysis, not just looking at their dividend safety, although that is fairly important. We're going to talk about dividend yield theory as well as the forward P, how that gives us an undervaluation signal. And as always, we're going to run through quite a number of metrics, including their free cash flow per share, their net debt to EBITDA levels, as well as some other very important metrics like the ROIC. As always, with each one of these 8 stocks, we are going to run them through our valuation model. We're going to get to the intrinsic value, what we determine to be the fair value price. We're going to talk about the margin of safety that is commanded at the current value. And as always, we're going to look to Wall Street to see whether or not they are very bullish on these 8 individual stocks, what their upside is, as well as their targeted price. Now, we also want to mention we are coming towards the end of earnings season. We do have a few next week just to keep a lookout. We have Oracle, which is reporting after the market close on Monday, as well as Adobe after the market close on Thursday. If there are any stocks in here that you do believe deserve a deeper dive, for example, Kroger is one that has caught our eye, do let us know and we can incorporate that into some of our analysis. Now, looking forward to the next few weeks, a few very interesting catalysts for the market. The first one is the potential rate cuts, which we will hear about around the 17th to 18th of this month. Now, we have a few analysts. First one is JP Morgan, their top analyst, who do say that they should be cutting their rates by around half a point. Now, the market has analyzed around a 39% chance for this happening, and one of the reasons why we are seeing an increase from moving to the 25 basis points to 50 is in fact just last week we did see the weakest payroll growth for the month of August since 3.5 years ago, which has started to dictate that maybe we will see a larger than anticipated increase. However, on the flip side, we do have economists here who believe that the Fed won't push the panic button just yet and will just start to cut it by around 25 basis points. Now, whether or not we do see that affect the market, a few things that we do want to mention just about historical data, and the data that we do have right now does go back around 1972, where we can in fact see the biggest outlier is this month. And it isn't just the monthly return of the S&P. We have a few more catalysts. For those that did read our latest free weekly article, we did note that historically the S&P does underperform leading up to a US presidential election. In fact, the data goes as back as the last 6 presidential cycles, where there was a negative 4.3% return during the lead up of the 2 months, and we have just entered September, so just something to be aware of. But ultimately, one of the reasons that we do invest in stocks, as we can see from this graph, the S&P 500, no matter what the election brings for the market, continues to climb higher over the longer term. So always do zoom out, something that we do quite like to talk about on this channel. So how about we now dive into the first stock? As you would have been aware, Google Alphabet is one that we do believe for some serious consideration. It has been hammered over the more recent period, although over the last 12 months it is still up around 12%, and if you zoom out over the last 10 years, it still has significantly outperformed the S&P, up 419%. Now, when we look at it in terms of the period range, it does sit around the mid, moving towards the lower end of the 52-week period, and we can in fact see a double buy rating seeking alpha in Wall Street. In fact, 4.38 out of 5 does indicate soon, if the price continues to fall, Wall Street will upgrade this to a strong buy. We note a hold from Quant, and for those that do like dividends, well, we can see they have only recently introduced it, but the yield does sit around 0.53%. And in terms of the valuation, the forward P now 19.8. This is a very low forward P, as we are about to show you, against the 5-year historical average, and in fact the lowest of the Magnificent 7 right now. So let's look at the earnings, and one thing to note here, something that we always love to see, not just past performance but also the future projections. Over the last 4 quarters, Alphabet have outperformed the analyst targets. That is a great sign, 100% track record, giving us faith moving over to the next 4 that they can in fact obtain those numbers, and we see the next 2 double-digit EPS growth anticipated, and if they do hit the full year of December 2025 8.69, the forward P will come down to around 17.36. So now let's jump into the financial metrics. We do get a dividend safety score of 80. Again, bear in mind they have just recently started to pay dividends. Market cap 1.86 trillion, and for those that are interested, it was reaffirmed just last month, and what this ultimately means is that a dividend cut for Alphabet is unlikely. Just some key recessionary metrics that will look for each one of these 8 companies. Now, they didn't pay a dividend, so no comparative data, but their recession sales plus 8.4% was well above the average of the S&P. In fact, during that time, it was negative 12. Now, in terms of dividend yield theory, something we love to look on this channel, it tells us a company is undervalued when the current yield sits above the 5-year average. As we mentioned, Alphabet very recently introduced the dividend, so we will ignore this for this company. We will use it though for the other 7. And in terms of the forward P, as we mentioned, 18.8 right now, sitting much lower than the 5-year rolling of 23.4. We would call this an undervaluation signal. And in fact, we do note it is sit higher than the communications of 12.1 as a sector, but remember, a lot of poor quality companies, and we do believe once we have done our deep dives of Alphabet that it does in fact warrant a premium to that sector. As always though, do remember we don't look at any of these models in isolation, and we will conclude towards the end. Then free cash flow payout, as always we do focus on this. Below 60% is our preference. It does give us that faith that management can offer double-digit increases. Remember, the earnings is susceptible to manipulation by management through accounting, so we do forego a lot of this in our analysis. Now, below 60% is exactly what we get, in fact 12% over the next 12 months, so for Alphabet we would be surprised if we don't see some very large double-digit increases to the dividend. Free cash flow per share, well, we want to see increases continued over the longer term, and that is what we get here, around 89 cents in 2014, 5.50 in 2023, and the great thing to note here is it is expected to continue that upward trend to 6.64 over the next 12 months. Then we move on to the sales growth. With more mature companies, we do want to see 3 to 7%. In fact, for Alphabet, we see nearly double digit every single year, other than the more recent year of 2023 at 9%. Good to note, over the last 12 months, we are seeing 13%. So for the full year of 2024, we could get another and very consistent double-digit growth rate to their revenue. Then for those that like to see their total sales in a numerical format, 66 billion in 2014, 307 in 2023, so nice growth annotated here. And one thing that we always want to look out for companies, not just double-digit dividend growth, but when they return excess cash to shareholder pockets through those share buybacks. And whilst we note Alphabet have in fact diluted your position over certain periods, we note over the longer term they have reduced it by more than 1 billion shares, 12.6 over the last 12 months. And in fact, we do note from 2018 they have been doing some consistent, although fairly small, buybacks year on year. Then we want to take a look at the ROIC, one of our favorite metrics, one of the most important. In fact, it does give us faith management are able to effectively allocate their capital. We want to see above 10% year on year, and what we notice here, not just consistently above that, but it has been increasing over the last 3 years, looking very attractive to investors in the mid to upper end in the 20s. Then we get to operating margin, a few things that we want you to point out when you're looking at your own analysis, not just increasing revenues, but operating efficiencies with operating margins as well as gross margins increasing over the longer term. What we note from Alphabet, whilst it hasn't increased massively, it has increased from 26% in 2014 to 29% in 23, and on a trailing 12-month basis, 31% does look very good. We then move on to the free cash flow margin, where we want to see above 5%. We get that from Alphabet, a very nice free cash flow machine, 23% in 2023. Consistent free cash flow, always a great sign, and if it's increasing, that is ultimately a high quality company indicator. Then we get to the final metric, the net debt to EBITDA, referring to the earnings before the interest, tax, depreciation, amortization. Below 3 is what we want to see, and the numbers below will reference the number of years it takes the company to pay off all of their debt net of cash on hand. Remember as well, this correlates to balance sheet strength, dividend safety, and this tells us for Alphabet it wouldn't even take them 1 day to pay off all of their debt net of cash on hand. Very, very strong, both in the dividend security as well as in fact that balance sheet strength. Now let's get to the valuation model. As always, if you do enjoy the content, value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now our intrinsic value of $187.64 is one that we will just briefly mention in today's episode how we got to. However, for the rest of the stocks, just to keep things very brief, we will move forwards. So just to let you know then, we have gone for a 10% growth rate. That is lower than the average of 24%, but do note here we have a low, medium and high, 10, 15 and 20. So with the 10% rate, we have the discount rate of 8%, which gives us the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get the equity value, divide by the shares outstanding, and as we can see, that intrinsic value, which does ultimately give us 25% upside. Now, for those that believe that is way too conservative, well, for transparency, we'll show you the 15% rate does give the intrinsic value of $264, therefore 76% upside. And for those that believe, again, it should be still higher, given the average is 24, well, at 20%, 371, as we can see, more than double the current price, 147. As always, on this channel, we do like to be conservative, so we will stick around the 10% mark. But do remember, this is very subjective, and you can grab a copy of this model by clicking on the pinned comment below and putting through your own numbers, whether that is for Alphabet or any other company that you do desire. So our intrinsic value of $188, as always on the channel, we start off with a minimum 10% margin of safety, and we execute on that if it has our 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. Now, if you believe that, well, a buy up to $169, then we keep going till it's near the current trading price, and what we see in today's episode for Alphabet, a 20% MOS. Now, remember, that is based on a 10% growth rate, which if you do believe already to be conservative, then at this 20% additional margin of safety, this could be looking like quite a steal. And in fact, we know Wall Street do believe this is much higher than our intrinsic value. Their price target, $204. They see 36% upside. So quick conclusion for Alphabet, 20% MOS with 36% Wall Street upside. Do give us your thoughts below as we do go through each one, whether you're buying, maybe adding onto the watch list, or for whatever reason you are considering selling. Now, before we continue, just to let you know, we have released our latest free weekly article. If you want access to this or any others, you can click on the pinned comment below where you can start reading straight away. And we have also released our 25 undervalued stocks for the consideration of the month of September, where we go through each one in quite some detail, look at the upside as well, whether we believe them to be undervalued, and which one we do sit within our own portfolios. So do check that out by clicking below. So the next stock we're looking at is Chevron Corporation. Now this one is sitting at its 52-week low, in fact down 17% over the last 12 months, over the last 10 years. Not the greatest, it is up only 13%. Do bear in mind though, this doesn't include dividends reinvested, and this is if you had bought 10 years ago. For example, if you do take a look towards the COVID lows of around $69, you would have more than doubled your current position. Now, we also know both Seeking Alpha and Wall Street do consider this a buy, with Quant giving this a hold, and we can see the yield does sit at 4.71%, and the forward P now just below the 12, sitting at 11.98. Now, when we take a look at their earnings, we can in fact see a 50% track record. In fact, they did miss their more recent quarter by quite some amount, 45 cents, and over the next two, they are anticipating negative growth to the EPS, but we can see that does change in quarter 1 and quarter 2 of 2025. One thing to bear in mind as we go through along this oil giant today, it is in a cyclical industry, so we will see a lot of peaks and troughs, and we do note their December 2025 forward P will come down to around 10.12 if they do hit that EPS estimate. Now, dividend safety, very nice to note, it is sitting at 90, which indicates very safe, and they did have a very nice increase at 7.9% in February this year, which is always great to see from a company that does currently offer what we would consider a fairly attractive yield. Now, in terms of looking at the previous metrics from the last recession, what we can in fact see is they did increase the dividend during the Great Recession 07-09. They had below average growth, negative 43%, and they also outperformed the S&P, negative 34, S&P coming in at negative 55. As we mentioned, very nice increase to the dividend this year, 6% over the last 5 years, 7% over the last 20. We would say these are some very good numbers for Chevron Corporation. And on top of that, they are a dividend aristocrat, increasing the dividends for more than 25 years and also paying a dividend without a reduction for the last 112. Now, when we take a look at dividend yield theory, we actually get that double undervaluation signal Current yield 4.71 above the 5-year rolling, as well as the forward P of around 11, lower than the 5-year of 12. We do also note it is marginally lower than the energy sector of 11.8, so a triple undervaluation signal for Chevron in today's episode. As we mentioned, you will get that cyclicality showing through the numbers. Below 40% is what we want to see for oil producers in particular. Over the last 3 years, it has been around that, although we do note 57 in 2023, expected to come down to 48 in 2024. So that is a positive sign that we should continue to see some very nice increases to this company. Now, in terms of the free cash flow per share, we do note negative 2014 to 2016. It has picked up since then, 1060 in 2023, 1370 expected over the next 12 months. But as we mentioned, year-on-year basis, do expect a lot of fluctuations. And that is primarily shown through those sales growth. Whilst we do want to see 3 to 7%, we do in fact note out of the last 10 years, 6 of them being negative, including 2023. And when you do look at it from a numerical perspective, what we do note is 192 billion in 2014 to the COVID lows of 94 before picking back up to 195 in 2023, which in actual fact isn't far off the 2014 numbers. Now, in terms of shares outstanding, they have done both buying shares as well as issuing shares. 1.9 to 1.86 does show, though, over the period a net minimal share buyback position. Then we get to the ROIC over the last 10 years, fluctuating significantly above 8% for this industry. Over the last 3 years, though, looking fairly positive, 12% on a trailing 12-month basis. And then this takes us to the operating margin section, where we want to see above 12% for this industry, around that over the last 3 years, and the same to be said for the free cash flow margin, looking fairly strong for the majority of the last 10. Then we finally get to the net debt to EBITDA, which is very important. We did see a very safe dividend score, so no surprises that it is below the industry 1.5 maximum we want to see. 0.4 in 2023, about that over the next 12 months. So Chevron Corporation does look to have a fairly strong balance sheet as well as a very secure dividend. So let's jump into the valuation. $180 is our intrinsic value. 179 is what Wall Street see, so they target 30% upside. Our two valuations are pretty much similar. And when we look at the MOS, well, 10% a buy at 162, 20% a buy at 144, and in today's episode at a 25% margin of safety, it isn't far off, around 136, 135. So this is definitely a strong consideration for someone that does like those dividends. 4.8% yield with some very good growth over the longer term, and in fact been paying a dividend without a reduction for more than 100 years. As always though, do give us your thoughts. Maybe this is one that you are starting to buy as it does hit that 52-week low. We then move on to Microsoft Corporation, where we get a strong buy from Wall Street, a buy from Seek Alpha, and a hold from Quant. This is now trading, as we can see, around the $400 mark, although when we do look at the 52-week range, it's pretty much sitting bang in the middle. Nonetheless, it is still up over the last 12 months, 21%. Over the last 10 years, significantly outperforming the S&P, up 760%. We also note the forward yield around 0.75%, and in terms of the forward P, sitting just above 30 at around 30.49. Very nice to note, over the last 4 quarters, MSFT have outperformed analyst targets, and over the next 4, they are looking at some very nice EPS growth. In fact, June 2026, the EPS estimate of 15.31 will bring that forward P to around 26.24. No surprises, dividend safety score does sit at 99, the highest score obtainable, so we have that very safe indication, and very nice double-digit growth just last September, meaning we are anticipating another increase just over the next few days, and in fact reaffirmed just last month that they do have a very safe score, which means a dividend cut for MSFT is highly unlikely. Now, how did they perform in the last recession? In fact, they maintained the dividend. They didn't increase it, but ultimately didn't cut it. They had negative 9% recession sales, not far off the average. Also, not far off the S&P return, sitting around negative 48%. Dividend growth, as we said, 10% last September, 10% on average over the last 5 years, with 60% on average over the last 20. Then when we take a look at growth, well, 14 years of consecutive increases, although 18 years without a reduction. As we mentioned, they did maintain it during the last recession. So how about dividend yield theory? What do we signal here? Well, you could argue 0.75, not far off the 5-year average, so either reasonable valuation, although moving on to overvaluation based on dividend yield theory. However, on the forward P, it does indicate reasonable valuation, sitting at 30.7, not that far away from the 5-year rolling of 31.2, although we do note, and no surprises again, that it does sit higher than the information technology, which is 23.4. As always, you do need to pay a premium for a very high quality company, which you could severely argue Microsoft is definitely one of those. Now, free cash flow payout, as we note, below 60%, and it has been below that every single year. In fact, decreasing 29% expected over the next 12 months. So we would be absolutely shocked if this month we don't see a very nice double-digit increase. And when we look at the free cash flow per share, something you would expect with this company, more than tripled that over the last 10 years, $9.97 in 2024, expected a marginal increase over the next 12 months to $10.30. And then when we look at the sales growth, again, no surprises from this high quality company, nearly double-digit increase every single year, 16% just in the more recent period. And when we look at it from a numerical perspective, well, in fact, they have nearly tripled their top line, $93.6 billion in 2015, 245 in 2024. They've also done some share buybacks, although we do note it isn't one of their priorities. As we can see, it is fairly trivial and very inconsistent on a year-on-year basis. And when we look at the ROIC, always love to see that consistently above the minimums and increasing, 24 in 2015, 30 in 2024. So definitely one that we would say a strong consideration just based on that metric. But as always, valuation is severely important before executing on any company. Again, high quality stock, as we said, not just increasing revenue, but also their margins, as we know, going from 30 to 45 in 2024. And the free cash flow is always very, very consistent and very, very healthy. As we say, sometimes for very good, consistent numbers, it is worth paying a bit of a premium. We also note the net debt to EBITDA, 0 for the majority of the last 10 years, 0.17 in 2024, 0.15 over the next 12 months. So again, no surprise with the dividend safety, and balance sheet does look excellent as well. So the intrinsic value of $445, as we can see, our margin of safety at 10% today, pretty much bang on what the value is, and a lot of people will maybe dollar cost average into this company, given it is one of the top high quality companies to own in the S&P. Other people may wait for an entry point. 10% for a company that does look like Microsoft with the metrics it has is definitely one that we would say for some severe consideration. And we do know Wall Street, however, don't agree with us. They have their price target over the next year significantly higher than our intrinsic value, $505, upside of 26%. And for those that are interested, at a 15% MOS, a buy at 378, and at 20% around the 356 mark. As we said though, today's episode of Microsoft sitting at the 10% level, and do give us your thoughts below. We then move on to ASML holding out the semiconductor giant that has been hammered very, very recently. In fact, we still get a double buy signal with a hold from Quant. This one is trading in the lower end of the 52-week range. It does have a forward yield of 0.88% and a forward P sitting at 36. And we note over the last year, up around 13%. Over the last 10 years, still significant outperformance of the S&P, up 661%. Now, very positive to report, very similar to Microsoft, 100% track record over the last 4 quarters. And moving forwards, they are anticipating some very strong growth, especially in 2025, triple digit in quarter 1, 80% in quarter 2, and ultimately at the end of 2025, if they do hit those targets, the forward P will come down to around 22.76. We can see as well the dividend safety does look to be good, 82, very safe, although a fairly mediocre increase to the dividend at 4.8% in July this year. Remember, around the 4% level is just the minimum we want to see just to keep up in line with inflation. And in fact, they cut the dividend during the last recession. They had below average growth, negative 56%, with pretty much an S&P return of negative 55%. Again, we do believe it is mediocre, this increase, given over the last 5 and the last 10 years, we did see some strong double-digit growth, and we do know they have been increasing those dividends for the last 14 years. Now, in terms of looking at this company on dividend yield theory, we have a massive undervaluation signal. In fact, it is very rare to see this company yield at 1% or higher, and when we look at the forward P, again, 27.3, that is below the 5-year of 34.2, but as always, we never execute purely based on these models. We do note, however, information technology does sit lower at 23.4. Now, in terms of the payout ratio, whilst we want to see below 50% for semiconductors, we note 74% in 2023, so it would have been essentially reasonable to have assumed that we wouldn't have got a very large increase this year. However, you wouldn't have noticed that by looking at the earnings at 31%, which was lower than the previous year. But good to report here that over the next 12 months, this is anticipated to come down to around 14%. When we look at the free cash flow per share, again, semiconductors, very similar to oil companies. It is in a fairly cyclical industry. That is why we do see a lot of peaks and troughs. It has peaked over the last 10 years in 2021 at 24.2, come down over the subsequent 2 years at 8.25, but we are happy to report over the next 12 months, massive increase anticipated to around $20.60. Then in terms of sales growth, actually very good for a cyclical company, 30% in the more recent year, although we can pinpoint that over the trailing 12 months, negative 2%, so do expect for the full year of 2024 not to be as large as we have historically seen. And then when we look at it from a numerical perspective, very, very nice to report, 4 times growth from 2014 to 2023, with some share buybacks over the period as well, buying back more than 10% from the last 10 years. Then in terms of ROIC, above 12% for the semiconductors, looking very strong consistently over the last 10, with the last 3 looking very, very appealing for investors. Trailing 12 month, though, showing 40%, still looking very positive right across the board. Then we get to the operating margin, and remember, operating efficiency is what we want to see here, and it has increased 26% to 33%. Same to be said for the free cash flow margin, consistently above the minimums, but we do see it come down from the all-time highs in 2021. Then we get to the net debt to EBITDA, very, very nice report, very similar, pretty much the same as Alphabet, the first company we analyzed today. 0 right across the board, not even 1 day for them to pay off all of their debt net of cash on hand. Our intrinsic value coming in at $1,152, not too dissimilar from Wall Street at 1173. They see 56% upside, the highest we have seen today. And when we do run it through the MOS calculation, well, at 10%, a buy at 1037, and we see in today's episode there is some very nice MOS for this very strong high quality semiconductor company. In fact, the 35% MOS level at $749 is right there around the current price. So today's episode, we are seeing 35% MOS with 56% in terms of the upside, and that is over the next year. As always though, do give us your thoughts. Semiconductors did suffer, especially over the last few days. Whether any others have caught your eye, for example, Broadcom has also suffered. We then move on to LVMH. Now we have a buy rating from Seeking Alpha. This one is now trading right there at its 52-week low. It has a yield as well around 1.75% with a P on a trailing 12 months of around 22.67. Over the last year, it is down around 13%. Over the last 10 years, however, it has outperformed the S&P up 285%. Now, in terms of dividend growth, very nice to report over the last full year, mid to high single digit at 8%. Over the last 5 as well as the last 20 years, this is a company that has offered double-digit increases. And we do also note when we look at the free cash flow payout, over the last 10 years, it has been around that 60% or lower that we do want to see. So always a great sign to see. Then in terms of the free cash flow per share, as always, increasing over longer term, it is something we get, although we do note it has come down from the highs of 2021, which you could argue was a rebound from COVID when everyone was locked down and therefore wanted to go out and spend when the lockdown was finished. And we note 21.2 in 2023, looking to rebound very sharply over the next 12 months to around 30.6. In terms of sales growth, well, as we note, 3 to 7%, it has performed a lot better, although year on year, lots of drastic movements. We note that COVID year of 2020, negative 17%, a large rebound, 44% in the following year, although it has started to come down 9% in the more recent 2023 period. And we do also note from a numerical perspective, nearly tripled that top line, 31 to 86 billion, and shares outstanding, nothing really to report here. Very, very minimal movement right across the board. Then when we take a look at the ROIC, always great to see consistency, which is what we get here other than the COVID justifiable period. 21% over the last 2 years, very, very healthy and very nice to report. And operating margin showing the efficiency, 19% in 2014, 26% in 2023, Free cash flow margins, well, whilst it has moved year on year, still looking very good, well above that minimum 5%. And the net debt to EBITDA coming down from the highs of 2.9 in 2014, 1.67 in 23, about there in the next 12 months as well. So no worries. Remember, for the majority of companies, we want to see this below 3, and always good to see that declining nature for this metric in particular. Well, our intrinsic value of $910, a little bit lower than Wall Street 92154, where they see 35% upside, but we do see some very nice MOS at the 10% a buy at 819, at the 20% a buy at 728, and in today's episode, a 25% margin of safety is where this company currently sits. As we said, Wall Street do believe this to be a buy, but do give us your thoughts. Do you believe this industry, if a recession is around the corner, will continue to get hit, or is this one that maybe you are considering dollar cost averaging in over the next few weeks? We then move on to Old Dominion Freight Line, one we haven't reviewed in quite some time. We get a buy rating from Seeking Alpha with a double hold from Wall Street and Quant. This one trades in the lower end of the 52-week range with a yield of 0.56%, a forward P just below 33. Now, over the last year, it has pulled back around negative 13%. Over the last 10 years, however, some massive outperformance of the S&P, up 686%. And when we do look back over the last 4 quarters, at a minimum, it has been in line with management targets. More recent quarter, a marginal beat of 3 cents. However, over the next 2, they are anticipating a decrease to the earnings per share. But ultimately, over the next few years, that EPS on the long term is anticipated to increase, with the forward P coming down to around 28.3 in 2025. Now, in terms of the dividend safety, 81, so it does look to be very safe, and a very impressive dividend increase just this year in January, in fact, at 30%. So when we take a look at the metrics, what we do note from the last recession, well, no dividend, so no comparative data. They had below average growth, but they massively outperformed the S&P with their negative 22% return, and not only a very impressive increase to the dividend this January, but over the last 5 years, 36% year on year, and we do note they have been increasing those dividends for the last 6 years. In terms of dividend yield theory, well, we do get that undervaluation signal on the yield. In fact, one of the highest yields offered over the last 5, 0.56 above the 0.4 average, and we do note the forward P not too far off the 5-year average, 31.7 versus 30.3, but significantly higher than the industrials as a whole, which sits at 18.8. In terms of the free cash flow payout, well, below 60% is exactly what we get, 22% in 23, 24 over the next 12 months, so no surprises why we see that very juicy increases to the dividends that we always want to note, and the free cash flow for the large part has been increasing, moving the right way. 371 in 2023, an increase of 435 expected over the next 12 months. And we do note sales growth, whilst you could argue this industry also fits the bill for a cyclical one. Over the long term, we note 2 years of negative to the top line, 6% in 2023. But ultimately, when we do zoom out, we do note it has pretty much doubled over the last 10 years, 2.8 to around 5.9 billion in 2023. What they've also done fairly consistently, although fairly trivial in terms of the numbers, reducing the share count from 258 to 219. Then we take a look at the ROIC, absolutely phenomenal, not just increasing over longer term, but going from 24%, which was already very impressive, to around 34 in 23, even higher on a trading 12-month basis. Remember, making it incredibly attractive for investors. And as we said, we love this operating efficiency, not just increasing the top line, in fact, doubling over the last 10 years, but their margins going from 16% to 28%, a very good sign. Again, a very good indicator of a high quality company. The same to be said for the free cash flow margin, increasing over the longer term in the mid-teens over the last few years. Finally, the net debt to EBITDA, again, very, very strong. In fact, 6 of the last 10 years have been 0, and over the next 12 months, not even 1 day for ODFL to pay off all of their debt net of cash on hand. Now, our intrinsic value of $205, only marginally higher than Wall Street, where they see 10% upside. Their price target, $202. And when we run it through the MOS, we're at 10% a buy at 184, which is pretty much at that current value. Now, this is a high quality company, and this one really we added just to have on your radar, although we would like to see a larger MOS level. At the 15%, around 174 is definitely one, if you do believe this is a company that fits your thesis as well as your portfolio, to consider around the $180 $175 mark. Again, for those that are interested, at the 20% point, 164, but in today's episode, a 10% MOS with 10% upside from Wall Street. And do give us your thoughts on this company as a whole, whether or not it fits your portfolio, and if you do like the value around the 10 to 15% MOS. We then move on to the Walt Disney company, where we get a double buy rating and a hold from Quant. This one is trading in the mid to lower end of the 52-week range. We have a yield now of just over 1%, a forward P of just under 18, and over the last 12 months, up around 8.6%. Over the last 10 years, however, it is down around 2%, and we can see all-time highs sitting around $200 mark in March 2021, around 3 years ago. Now, in terms of their earnings, looking fairly positive historically. They have a 100% track record over the last 4 quarters. Next 2 quarters anticipating double-digit increases to the earnings per share. And ultimately, if they hit their September 2025 EPS, the forward P will come down to around 16.88. Now, given they've just restarted the dividends, we don't have a dividend safety score, but that is one we will keep our eye on over the next few quarters. But as we can see, they did in fact cut that dividend not too long ago, hence why we do see these numbers right across the board. So something just to bear in mind that is shown through this graph. 2020, that dividend was cut only to be restarted last year. Now, in terms of taking a look at the payout ratio, given they have restarted the dividend, 11% in 23, 20% over the next 12 months, does indicate that we are hopeful for a very attractive increase. When we do take a look at the free cash flow per share, we do see a lot of inconsistency, although the positive is here to note that it has restarted the upward trend. 2022 lows of 59 cents, 268 in 23, and anticipated nearly double over the next 12 months. In terms of sales growth, well, no surprises, the parks would have been closed during the COVID lockdown, negative 6% for that year. But over the longer term, we are seeing at least the 3 to 7% that we want to see for the more particular mature companies. Over the longer term, nearly doubled from 49 billion to 89 in 2023. And shares outstanding, they would have diluted your position over the longer term, although we do note a little bit of share issuances as well as share buybacks through the years. Then when we take a look at the ROIC, something we do want to see with companies we like to invest in, as we mentioned at the beginning, a minimum of 10%. And whilst we don't see that here, it has started to recover from the lows of 2% in 2020 and 2021, 7% on a trailing 12-month basis. So it could be one to consider as a turnaround story, a value play as well. And the same to be said for the margins. Ideally, we want to see this back up to the levels of 2014 to 2018, 6% in 2020, 5% in 2021. But again, we are noticing the margins have started to increase over the last few years, and the same story to be told for the free cash flow. At a minimum, we do want to see 5%, something we see in 2023, as well as on a trailing 12-month basis, the increase to 9%. Then we get to the net debt to EBITDA, looking very inconsistent, 3 the absolute maximum, which we do see it peak above that in 2020, 2021. But again, it has been decreasing, 1.99 in 23, over the next 12 months, 2.06. So just something maybe to keep an eye on. And when we do get that dividend safety score, we would anticipate this to sit in the safe level. So what about the valuation? Well, in today's episode, our intrinsic value of 123 is marginally higher than Wall Street 119, and they see 36% upside. When we do run it through the MOS, well, at 10%, a buy at 111. At 20%, we see a buy at $98. And in today's episode, we do note a 30% margin of safety around the 87% mark, with 36% upside from Wall Street. As always, though, do give us your thoughts. This is one that clearly does split the community when we do refer to this company. But as always, do give us your thoughts, whether they are bearish or bullish for the Walt Disney Company. We then move on to one of my favorites in this group. It is Visa. Now, this one we have a double buy with a hold from Quant. This one is trading in the mid to upper end of the 52-week range with a forward yield of 0.74%, a forward P of around 28.2, and over the last year it is up around 13%, although we do see it slightly lower than the all-time highs of $291. Over the last 10 years, though, up 422%. Again, another one that has consistently outperformed the S&P. No surprises, they have outperformed or at least been in line in terms of management targets. In fact, the more recent quarter they were in line. Moving forwards for the next 2, double-digit EPS growth anticipated, and we can see 11.07 expected for September 2025, bringing down that forward P to around 25.24. We note a very safe dividend score, 99, again the highest obtainable, with a very nice dividend growth increase just last October of 16%. And when we look at the last recession, well, they did increase the dividend. They did also have plus 9.5%, which remember the S&P negative 12. Dividend growth pretty consistent in the double-digit increases, which is one of the reasons why we do love this as dividend growth investors, and we do also note 15 years of consecutive increases for that dividend. Now, in terms of dividend yield theory, we do get a sense here of undervaluation / slight reasonable valuation, 0.74 versus 0.71, 26 on the forward P, which is below the 5-year of 28.2. Although no surprises again, a lot of these companies that we have talked about today sit higher in the sector overall, as these are high quality companies. In terms of the free cash flow payout, well, below 60% is what we see. No surprises given those increases, 21% expected over the next 12 months. So we would expect this to continue on a year-on-year basis, and always great to see increases to the free cash flow. In fact, more than tripled from 2014 to 2023. Again, increase continue to expect over the next 12 months. Then in terms of sales growth, pretty much double digit for the majority of the last 10 years, 11% in 2023, 10% on a trailing 12-month basis. And from a numerical standpoint, we do see double that top line over the last 10 years, with also a lot of returning of excess cash to those shareholders through those share buybacks, fairly consistent, but also fairly minimal on a year-on-year basis. ROIC, very, very good to note here that it is looking very strong every single year, increasing from 2020's 21%, 34%, and looking to increase as well based on the trailing 12-month of 36%. In terms of the margins as well, one thing we love about this company, both on the operating side as well as the free cash flow, not just significantly above the minimums, but also consistently very, very high. Always a great sign, and a free cash flow machine is definitely one that is Visa. Then we finally get to the net debt to EBITDA, well below the 3, 0.05 in 23, 0.14 over the next 12 months. So definitely no surprises on that 99 very safe score, as well as the fact that the balance sheet does look to be very secure. Now, our intrinsic value of $323 is a little bit higher than Wall Street of $315, where they see 13% upside. However, when we do run it through the MOS calculation, at 10% a buy at $291. At the 15% mark, you would have to wait, although not too long, around the $2.7. So in conclusion, for Visa, 13% upside from Wall Street, 15% MOS, and one of the high quality companies that we have reviewed today. As always, do give us your thoughts in the comments below. If you enjoyed today's episode, smash that like button, hit that subscribe and bell button so you are continually notified. Don't forget to sign up to the free weekly newsletter by clicking below, as well as joining us on the Patreon and talking about our weekly buys and sells. As always, have a great day, and we'll see you all on the next one.